This is Alan Bush with ADM. In the stock index futures, we did see prices opening sharply lower. This directly linked to news that the Chinese government increased loan requirements, basically taking a shot at the surging Chinese equity markets. So this appeared to be a surgical strike against advancing Chinese stock markets and is not a general tightening of credit. So this did have the desired effect, taking Chinese stocks down, with those stocks suffering their worst declines since 2009. Of course, there was spillover effects into other equity markets overseas, including here in the U.S. However, we do feel that there is likely to be a recovery, at least a partial recovery, here in the U.S. equity markets. So even though stock index futures did open sharply lower, I think they will come back. Not sure about trading back to unchanged on a day, but I think we can see a significant recovery in today's session. Still thinking that the main trend is higher as well. Over in the currencies, a very unusual trade. The dollar index trading sharply lower, and most other currencies trading sharply higher. There was no obvious news that would account for any of these price movements. In fact, there is more talk about the possibility of the Fed becoming more hawkish in their statement at their upcoming policy meeting. Some talk that they could eliminate the term considerable time for the Fed to keep rates at a very low rate. That is actually a bearish situation for currencies, and it is bullish for the U.S. dollar. In other words, a hawkish Fed is bullish for the greenback, and yet the dollar is lower. Most currencies are higher. So until we know exactly what the main reason is for, as far as why these currencies are moving as they are, I think I'd stand aside in the currencies. Of course, we do have a reason why the Canadian and the Australian dollars are both higher. We are seeing a rebound in commodity prices, so the so-called commodity currencies, the Australian dollar and the Canadian, are reacting as they should to firming oil prices and firming metals prices. Over in the interest rate markets, we are seeing futures overperforming the news. The possibility of a more hawkish Fed is actually bearish for treasuries, and yet we are seeing good gains today. So the fact that we are ignoring bearish news is a sign of strength for the interest rate futures complex, which is what we have generally believed for quite some time, that the main trend is higher. Also, even though there is talk about the Fed becoming possibly more hawkish at their upcoming policy meeting on the 16th and 17th of this month, we are seeing futures performing extremely well. Even the probability of a Fed rate increase at the October 2015 meeting actually declined a little bit from 84% to 82%. So Treasury is putting in a very good performance, ignoring some bearish news. That has to be viewed as a sign of strength, especially for the 30-year bonds. So continue to be bullish on Treasuries, especially at the long end. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.